movement something called a fair value gap. And this is starting to dive a little bit more into reading candlesticks and reading institutional price action that are going to give us points of interest that we're going to want to look at as potential areas to be able to set up potential positions. But first we have to understand what a fair value gap is. So if we look at this diagram here, we can see right here, these are candlesticks. So it's representing the total movement over that time increment. On our chart here, we have 1 day selected. So each one of these candles is going to show us the price it started for that day, the price it ended for that day, and the total range that the price moved over that time period. Oftentimes what will happen is if the price moves very, very quickly, as we see in this example here, that leaves this gap in price action. So if we're looking at this candle, and this candle, the highest point here on this candle and the lowest point on the third candle don't have any period of overlapping, which means that the price so aggressively moved up through this zone and never retested it, which will oftentimes act as sort of a magnet for the price to meet equilibrium before having a continuation if it's going to in that direction of the market. So these areas here called fair value gaps, when the price comes down to sort of fill that inefficiency, and these are oftentimes big levels of institutional interest, being that there's often a lot of liquidity resting in these areas for the price to seek the equilibrium and then continue moving. And there's two types of fair value gaps. The first kind is often referred to as a buy side imbalance, sell side inefficiency, or a BISI, okay, which is also called a bullish fair value gap, basically where price action is generally moving in a bullish direction, creating a fair value gap. The same thing is true for a bearish fair value gap. So we have bearish price action, sell side imbalance, buy side inefficiency created here from 1, 2, 3 candles not having overlapping wicks here and creating this area of inefficiency, which price tends to gravitate towards to fill the equilibrium and once again make a continuation move. So if we look at an on chart example, we have a new trend being established here. We have a move up, down, we have another move up, creating a break of structure. And you'll notice here, all right, we have something called an order block, which we're going to get to in a second. We also have this big candle, which is creating a large displacement. And notice how this candle is not overlapping this candle. Now we have price pushing all the way up and eventually having a corrective move down. And so you can see as we play this forward, price comes back down to fill that imbalance, reacts off of that level, and then has a continuation up higher. You can see once again, this one was never tapped back into. And you'll see this fair value gap as well was pushed into, didn't make a close through, closed above before having the price action move up. All right, and as you'll see, price comes down underneath this level, creates a change of character and leaves behind a significant sell side imbalance, buy side inefficiency zone. Price will push down further. Notice how it comes into the midpoint, doesn't close through the halfway point of this fair value gap and continues making a move to the downside. Something to also take note of is this midpoint zone in a fair value gap. It's also often referred to as the consequential encroachment. And basically what that means, if we want to consider this area a respected area for a continuation in the trend, we don't want these candles to close beyond the midway point of this fair value gap. And so what I do a lot of times, and we'll get more into this in a second, is target the midpoint of the fair value gap as my entry. So if the price does tap into this and have a response, it's often approximately the best area to enter into these trade positions to really maximize the full distance of the move.